There are a lot of conflicting opinions and a lot of buzz on the internet with regards to if you should buy into the stock market now or later. And today, I wanted to share with you guys what I think is the safest way to invest in this volatile period. So, the stock market has made quite a rebound since its lows in March, but some people are saying that the stock market shouldn't behave like this because companies' earnings are getting cut and that the real bottom is not yet here. And a few weeks ago, there were so many articles and videos being posted with titles like this. The crash has only just begun. Stocks are now overpriced by 22% according to this rule. Why the stock market is nowhere near a bottom and investors can expect a massive hit. On the other hand, you have the bulls saying things like, money managers see more COVID pain for stocks in 2020, but better days in 2021. Stock market may have hit a bottom based on this one behavior. We've seen the lows in March for the stock market, says man who called Dow 20,000 in 2015, and we will never see those lows again. Now, there is one thing that we do know for sure, that none of these people can tell the future. None of them can calculate every single variable that will happen in the next year, and not even in the next several months. Many of them can and will make guesses, as shown earlier. Some will be right, and some of them will be wrong, because they are claiming totally opposite things on the future of the economy. So, should you invest your money now, or should you wait for the next bottom? Before I answer that question, I want to go over the three main styles of investing. Number one is the lump sum investment. This is where you invest everything you have at one point in time. The benefit of investing everything you have is that it exposes all your money to the potential market gains. But that also shows the huge potential downside of investing everything at once. Say I had $12,000 of free cash back in December, and I saw all my friends making money in stocks as the market continued to hit all-time highs. Now, I wanted to get in on investing out of fear of missing out, and I put all my stocks in the market. But by March, because of the pandemic that no one predicted would happen in December, I have lost 30% of my value. So that's the big downside of lump sum investing, because stocks are volatile investments in nature. The second way of investing is to wait for the market to fall before you start investing. Investors that do this hope to buy the dip and get in when stocks are valued lower than it was before. The downside of this way of investing is that you may be buying in what you thought was the dip, but the market continues to fall. Or you are waiting for a large dip, but the market stays on a bull market and you miss the gains that you'll never see again. For example, say you had some cash back in 2011. The market has recovered quite a bit from the 2008 recession, but you think that it's far too expensive to invest right then. So you wait, and you wait, and you wait, and you wait 8 years. The market has risen an average of 14% a year. The coronavirus does bring the market down, lower 30% from its highs, but you would have been in a far better place if you started investing your money in 2011. The last way of investing is the way I invest my money, and I think it's a better way to invest than either the lump sum way of investing, where you invest all your money at once, and the second way, which is to wait for the dip. Because if you invest your money at once, you are assuming that the stock market will continue to rise without dropping. And if you are waiting for a dip, you are again assuming that the stock market has bottomed and will continue to rise. Both of these first two strategies require you to be predicting the future. I personally don't have that power, and I don't think any of us can predict exactly at what points in time is the best way to invest your money. So that brings me to the third way of investing. It's to invest your money on a periodic basis. You can do it every 3 months, every month, every 2 weeks, or every week. This strategy is called dollar cost averaging. By investing on a regular basis instead of going all in at one point in time, you reduce the downside risk of a large investment and take advantage of the market's volatile nature of going up and down every day by lowering the average price you pay for a share of a company. To give an extreme example, before the pandemic hit, the US stock market was hitting all-time highs and breaking records. And imagine I had $120,000 that I could invest. And out of fear of missing out, I went all in because I wanted to be invested now that everyone around me was in the green. But the pandemic hit a month later and wiped out 30% of my $120,000 investment. So I am down $36,000 and left with $84,000. But if I decided to start investing, but with just $10,000 in the first month, I would be down only $3,000. That's not great, but it's a whole lot better than losing $36,000. Now, the inverse can also be true, but do you know when the market will hit its record high again? Will it be next year? Will it be 10 years later? No one really knows because last time I checked, time travel hasn't been invented yet. So, to summarize, I think it's best to get in the habit of investing a set amount, an amount that you can invest on a regular basis. It doesn't have to be a lot. What is important is that you get started and you get your feet wet. Like some bears say, we may not have seen the bottom yet, but by using dollar cost averaging, you can soften the blow to your portfolio if another bottom comes. And if the market continues to rise, you won't be missing out on the profits. Thank you guys for watching. If you enjoyed the video, please don't forget to like, comment, subscribe, and share the video with your friends.